Hello, ladies and gentlemen, and welcome back. Well, we had one of the lead analysts of 2022 calling the bear market before it happened, saying bad things are about to happen again in February. We'll talk about that in today's video, along with our thought processes into the three big pillars of this week: earnings, non-farm payrolls or the jobs numbers in the US, and of course, the interest rate rises and the FOMC meeting. Imagine if they came out and they said something other than 25 basis points and they said, hey, we need to do 50. What would happen to the stock market? With stocks sitting at such critical levels across the S&P 500, Nasdaq, and of course, individual commodities and also cryptos, we have a lot to discuss in today's video. Don't worry, we'll be covering it all. Let's get into it. Well, welcome back everybody to the Daily Show where we talk about markets around the world. I'm pretty pumped for today's video, but we'll get started with the news. We'll then get into, of course, the lead indicators, the macro data, and the key levels that you need to be watching in the markets right now. So Morgan Stanley's Mike Wilson had a great call in 2022 and is now saying that this January run could be false and we need to be careful into February. I tend to agree with him in many of these points, and we'll talk about one of Mike Wilson's actually really good ideas, I believe, for 2023 investing and really investing through recessionary periods. And he believes investors are now forgetting one of the cardinal rules, which is don't fight the Fed. Let's face it, does the Federal Reserve realistically want a 4,200 SPY or a 4,300 SPY? The answer is no. They are working on partial demand destruction here. Really lowering inflation is the game, and they need to get it as quickly as possible back down into that parameter of 2% to 3%. Will they get it there if the market's going super bullish? No. And I can already tell you that I've been watching some secondhand markets out there. And actually, as we've seen Bitcoin and these tech stocks, specifically the hyper-tech stocks, go up, we have seen a literal material increase in things like used cars and also things like used watches. Both have actually increased over the last couple of weeks since we've seen those rallies. It's amazing how fast these market dynamics are occurring. Anyway, regardless of that, getting into the stock market, there are a few other reasons why we need to be a little bit careful. So could this recent price action be a reflection of just the seasonal January effect and short covering after a tough December to a brutal start of the year? Well, this is something that I think, again, is pretty common. Yes, January tends to be an incredible run period in markets, but more importantly, we do also know that that tends to have that slowing effect in February, which we've covered on previous videos. Specifically, look at our video that we covered over the weekend. It has a lot of information about that. Let's get into another thing, though, that I think Mike Wilson has come up with as the best, which is something that people don't talk about much: equity risk premium. So basically, during periods of recession, we tend to see equity risk premiums spike a lot higher than it usually is. And this has not happened right now because, of course, we're not technically in an official recession yet. Although we believe here on the channel we will be in the US. Whether that's super hard landing or a soft landing is soon to be seen, and I'm sure we'll find out by the end of this year. But this is something that a lot of people don't discuss. Now, equity risk premium is the difference between the return of market, the cost of equity, and the risk-free rate, often considered like inflation, protected bonds, or something like that, treasuries in particular. So this is something that tends to spike, and we've seen it spike during every other official recession that's happened in there. It does lead to usually lower asset prices. So it's something that we need to be thinking about and have in the back of our minds this year to be very, very careful about. Reversals in price momentum. Now, we're talking about commodities a lot on this show. Specifically, I've brought up what we call Dr. Copper. Now, for anyone that doesn't know, copper is pretty much used in most constructions and, of course, a lot of things to do with the technological age. Now, if copper price is declining and the stock market is not declining, you have to start saying what's going on here. But specifically, we've seen commodities across the board, including softs, start to decline heavily over the last kind of 6 months specifically. And this is demand destruction in play. We've seen commodities go from over 50% here in the rate of change down to less than zero. Now, when we get these reads, what happens to commodities and then what happens to the stock market? Well, once we have over 50 to less than zero, we tend to go into a period of lagging commodities. In fact, the next 1 month, even into realistically 6 months and 12 months, doesn't have very good statistics with positive returns over that period. Here's a read of over 40 to 0. It's even worse. And you'll notice here only 27% of the time when you got a read like this. Look at some of these dates, by the way, when these have happened. Only 27% of the time do we tend to have realistically any positive returns out of it. Now, does this affect the S&P 500? Well, it does and it doesn't. It seems to have an effect on it during the kangaroo period, which is the kind of next 2 weeks into 6 months. But then after that, often it will return better. And this is kind of in line with our thought processes. We've had a great start to January. Will we have a bit of a weak Q1? Remember, VIX, volatility or fear index, tends to spike during Q1 and Q3 of the year. They're the two periods that you usually see VIX spiking. And we tend to see that February sell off into March, and then of course a return to form in April. At least historically, that's what's happened. Every time's different, but we will be paying attention to it. Look at some of their reads though and where these have happened. Not exactly giving you a super amount of confidence, especially the reads in the 70s, and of course the reads that we've had back in 2007 and 8. So everyone's talking about this, and I don't think it's necessarily the gospel anymore. And I'm a bit sad because it's definitely one of those indicators that I've liked over the years. And that's the Santa Claus rally with the first 5 days, with the positive January return, and the previous year was negative. So what that usually has meant is pretty bonker returns over that year. And we probably will finish, obviously we'll find out over the next 24 hours, whether January will end up finishing as positive. So far, we don't know. But we are checking out these charts, and that's a great statistic and something that I think that I would always keep in the back of my arsenal for investment and thinking about statistics. This is something that hasn't failed yet. Will this be the year it does fail? A lot more people are talking about it. Over at FX Evolution, follow us on Twitter. Links in the description down below if you're interested. We've been posting a few really great charts. Specifically, this is the one we've been following recently, and that's been smart money inflows versus dumb money inflows. And you'll notice that basically smart money's been kind of fading this rally recently, while dumb money's been purchasing heavily. And it's interesting because when you think about the levels, we're actually at still below a level we were back before the sell-off in December. Yet FOMO is much higher. It's just amazing how the markets have done this. It's just because of the tech stocks that have been going, all those hypertechs and everything like that. But when we tend to get readings this high with dumb money, you've got to be incredibly cautious in markets. Yes, you can still day trade. Yes, you can still watch markets, realistically and get involved in those trends, but you've got to be careful. And of course, part of the game in investing and trading is risk preservation. In terms of earnings, beat data versus, let's say, misses. This is one of the worst earnings seasons we've seen for a long time. Obviously, this is Q4. But once we get Q1 and Q2, that's where the pain could be in the economies. We're going to have to find out in the future. Only 62% beats, 254 so far, misses 155. During a traditional earnings season, we're usually 67% plus at this point in time during the earnings season. So definitely not meeting those expectations overall. I also thought this was a pretty good tweet here, which is the S&P 500 median PE forward ratios versus the current ones. So median over since 1982 is 15.43. Today, it's 17.6. If we actually take out kind of like the top 10 stocks of the US, we end up at a 14. So it really shows you how much of the forward PE is concentrated in the big tech stocks in the top 10 of the S&P 500. And this is a lot to do with index investing. Over the years, S&P 500 index, rightfully so, I guess, has become probably the go-to for so many people to invest in. And that's causing a little bit of a problem when it comes to just stacking big tech stocks or stacking the top end as much as possible. I remember it buys it based on average market cap and it swells some of those premiums. So if we do go into some form of recession and markets start pulling back on their valuations, we will need to be careful still with those big tech stocks. Let's move over to the S&P 500 index averages over periods of time. As we've mentioned, February tends to be a little bit weak. May also, sometimes has been weak. And then you've got September just absolutely, kicking out of the ballpark of one of the worst times of the year to be in the markets. Yes, it's actually worse for tech stocks. So we'll have a look at the US 100, the Nasdaq, in our next video. Make sure to subscribe and check that out. It'll be a good one. So what about the fear and greed index? Well, that's declined over the last 24 hours from 69 down to 67, still incredibly high. Obviously something that you watch. It won't give you too much edge, but it's great to see when things are at extreme fears or extreme greeds. Along with the VIX, this can be a great precursor to follow, some of Warren Buffett's, I guess, investment advice, which is buying when others are fearful and, of course, potentially selling or reducing when others are greedy. Let's have a look at the big thing here. This is earnings results. Now, I've got AMD coming up today. Each day of this week, I will pick out the big tech stocks, and what I'll do is I'll get the implied volatility based on the options market ranges for these. You'll notice that the expected move of AMD is 8%. I think this will also feed through to NVIDIA. So expect NVIDIA to be an interesting chart over the next 24 hours. After the close, we'll see this result. And this could be a big one for the market. Semiconductors across the board may move, and AMD is certainly one to watch, specifically for NVIDIA traders. Just before we jump into the charts, though, and have a look at all the key levels that you need to be watching right now in the lead indicators, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. You can see on the screen, there's a whole bunch of extra special offers for members of the FX Evolution community, especially if you're from Australia and New Zealand. Check them out down below. But for anyone else in the world, do remember, this is the last day to open up an account, fund it with as little as 1 cent, and get into the draw for our very special prize draw of one of each of our courses. Remember, all you have to do is open an account, fund it with as little as 1 cent by the close of 31st, and effectively, you're in the draw. Now, if we're having a look at why we like the platform, it has to do a lot with some of the features it has. And this is one I've brought up a lot, the heat map. And this is the last 24 hours of change in the markets. Now, you might think everything sold off. Well, some things did, others did not. And what you'll see here is defensive sectors, actually, for the first time in a while, utilities, tobacco, investment, soft drinks, integrated telecommunications, these were the ones that actually were buying on the session, or at least holding their own. That's defensive. Now, that's the first defensive move we've seen in the markets for what seems like pretty much a January period. We always follow it here on the channel. It's very important to look at. If you have a look at the last 10 days, what you might notice is that it's a totally different story in terms of what's been doing well. We've seen, of course, the rises of semiconductors again, application software, movies and entertainment, and automobile manufacturers, thanks to Tesla, have been absolutely flying, possibly not with the right precursors. But you want to have a platform like this that allows you to see those sector rotations. Definitely give them a go. Check out Tiger Brokers, links in the description. Let's get into it. So I also thought I'd include here the staples just on a chart of the last 24 hours. You can see staples, utilities, and even healthcare, some of the top performers of the session. Some were down, but at least they saw some rotation. This will be something we follow. If we do see rallies in the stock market, then what's rallying the market? Is it technology or is it the defensives? The more defensive the market goes, the more signs we have that it is a false rally that we should fade. And of course, we'll be looking at that together as we go through the charts. Let's begin with the charts of the VIX. Of course, the fear index did spike as fear came back into the markets. Could be a little double bottom, focusing in here at the 22 high. Obviously, you'll have like a little trend line going through as well. So we'll probably watch and set like an alert somewhere around 22. As many of you would know, anything above 20 is theoretically a bearing kind of market where the bears are in control. And we've seen during 2022, one of the big plays being, somewhere around that 18 to 20 period, markets generally selling off. Will it be again the way in 2023? Well, so far it's put pressure on this 18 level twice. And we've just seen the VIX spike recently into the February kind of run. US 2-year continues to go up into the FOMC meeting. Expectations obviously changing here a little bit with yields. One of the things we like to do on this channel the most is to have a look at the forward yields. I'll be bringing you all of the updates as we see the FOMC. But realistically, we're still sitting around April being at a 4.8% according to the market. The Federal Reserve says they're going to get to 5% plus. This is where the market and the Fed are fighting with each other. If the Fed does push a 5% narrative plus, then you will see the market not like it, and most likely it will start to drop off as they are calling the bluff of the Fed here in terms of the bonds market. Let's move over to the dollar index. First good day for a while for this one. Actually closed above a whole bunch of wicks. Fairly significant closure. Definitely something that we're paying a lot of attention to, and this level is paid attention to because of so many reasons. You'll see all these lines on the chart. Basically, I'm just stacking complements at this level. But you can see over on this right-hand side, we have a long leg doji and we have a long leg doji. We don't have any decision made yet on the weekly, but I am liking the fact that the last 24 hours was actually a little bit stronger. If we jump into the 2 hour, you'll also notice we snapped off all of these wicks and created a bullish close. I still have my alert sitting up here at 102.35 because we're not out of the worst yet. We have seen some strong price action, but unlikely that we're out of everything yet. These pickup lines were definitely the last level of resort for the DXY, and in the next 24 hours, it'll be interesting to see if we get back down to 101.82, what happens there. Intraday scalpers, I'm sure, will be watching that zone. Let's move over to copper. Now, this is one that I've stacked quite heavily. I mentioned this on the show, our live show we do every single Monday into the open here on the channel. And one of the things I got out was a volume profile, and I was showing everybody this area here. So it's one of the most traded zones, and we returned back to the golden pocket at the same period. Leading into Chinese New Year, leading into all this hype and FOMO and everyone feeling so great, is Dr. Copper about to turn around to the downside? This is one of probably the most bearish zone I've seen on it for a long, long time. And it got in there. I'm watching this like a hawk because I do think this is an important chart to watch for. If we see copper decline, that is not usually very good for the world health. And of course, going into Chinese New Year, a big part of that was usually they stack commodities and they stack metals. And then after we see a drop in price. So be careful around the metal side, I think, after. And that leads into gold, which we've discussed as well. It's still holding itself as best it can between these two green boxes. This is still where the bulls have control of gold. We're waiting for a 1935 breakout. The trend is still theoretically up. It hasn't really changed heavily towards the downside, and the market is dull. So it's very difficult to short it, and to buy it, you're just looking for realistically breakouts. We're stuck in a zone for this particular one. Let's move over now to oil. Now, oil had a little bit of a weaker day. It actually broke below this little box I had here. So this is an interesting one because from the surface of it here, oil kind of looks weak again. I'll find out what happens over the next 24 hours, but I think we'll have to get back into this. This was certainly an area that I was expecting buyers to recommit to. Obviously, underneath that, you still have that little area, which is what's bouncing off at the moment. But I think the next 24 hours will get a lot to do with what we like and what we don't like about oil. For a long time, I talked about 65 a barrel. Obviously, after 77, I thought it might go bullish, which was in here because that was a big shift. It's gone up to the resistance and it's kind of forming a Wyckoff style. So I'm not sure which side this Wyckoff's on just yet, whether it's a accumulation, this is a false break to the low ends, but I do feel like we're going to know more very soon. So watch this space on oil. Tesla hits some interesting points. Expected options weekly highs and lows have changed, so I've updated those accordingly. But Tesla got back into that supply zone and just too much for it, these runs. Obviously, the squeeze was set with some take profiting. Probably a lot of people taking profit due to the fear of the market around them going down. And I was hoping that we would see Tesla actually rally through here. It's possible and then drop off. But yeah, we haven't seen it yet. Do we have any insights into the smaller timeframes? It's kind of gambly here. It really is. It depends a lot more on the stock market than anything else. So we'll get into the stocks and then we'll come back to Tesla in the future. I've had a look at the options. Even the options aren't giving us a full kind of breakdown just yet. Move over to Apple. What's happening here? Apple's back on its downward trend line, or basically testing it from the top up. So it's kind of like on support leading into the next session. Interesting point for it. Could be that the next session's actually a bit of a rally session. We'll have a look at the S&P 500, but Apple at a little support here. Not a major one. Obviously, we're not at that expected weekly low yet, which is at 140, but this will be an area to watch and set alerts for. So yeah, tough here on the Apple as well. AMD, now I want to bring this up. I've got the expected weekly options highs and lows. Now notice they're pretty wide. So you're talking about a 7% to 8% implied vol move. Pretty big move. Now, at the moment, we have a gap up and we have a structural base. If AMD ended up opening down, it would actually be, again, setting up an island. So that could be something to watch out for. But we know that we're pretty much 24 hours away now from earnings reports. AMD is going to have a big one. And depending on where it ends up, see, what I would like it to do is rally, earnings report to come out, gap down, and then that would give you, of course, the island. And that's why I often say patience, react, don't predict, because that would be that would be better. Otherwise, we're right at that kind of resistance level ahead of the earnings. I think this will feed through and bleed through to things like Nvidia as well. Critical level for the markets. Obviously, weekly close highs, daily close highs. I think we all know what's at stake here for this. If it breaks through, next level is probably 85.64. So something to watch. If you're on the bear side, though, you're really looking for it to probably hold through this session. Then maybe a bad earnings rallies it down. And then hopefully it's not too bad in them open something like that, and then moves towards the expected weekly options low. That's certainly a play that I would be looking at, and considering. Let's move over now to CQQQ. I wanted to mention this because we have another island-based setup here with the Chinese market. You can see that it went into our resistance zone. This was something that we've talked about a few times, and it critically hit it, created a small island, then brutally dropped 4% in the previous sessions that before it closed. So this was a big one here. And yeah, it's looking kind of bad. And it had a great run on it. There's no doubt that this had an absolutely epic run, went up 71% as an index. But yeah, this is a very critical zone here for Chinese, Hong Kong stocks, everything. They're all in a pretty brutal level, and something I was watching. Natural gas, we'll keep coming back to this as I think it's fairly important to check it out. Absolutely no base yet on it, but I do have this yellow line down here just to show where I think prices could go. And if they get down to there, I'm interested in seeing how it reacts. We'll talk more about this as we see more come through. US 2000 Russell, critical level, obviously rejecting it right now, coming down to a key support in the last open, and it's kind of just hovering. It's kind of in that little miniature buy zone. So we'll be interested to see whether the markets can rally through that. What about the QQQ? Well, here is the QQQ. It spiked that high and then instantly rejected like the rest of the market. Again, I'm interested to see what happens here. We have our expected weekly options highs and lows. This is where 68% of the time the market will stay between. And we're looking hopefully for a little bit of a rally, and then potentially maybe earnings drops the market through, or the FOMC. So again, it's setting up at resistance. We know this week's going to be a big one, because if we breach these, you'd have to think markets start to make fairly significant movements forward. I mean, we could be looking at a 310 for the QQQ if we break it through. And it really comes back to the SPY. Look at what happens if we breach this zone. Here's the SPY. Here's the expected weekly options highs and lows. If we breach that, 420, even 430, super open in terms of the markets. And you can see at the moment, our weekly options low is at 397. I want to look at the futures though, which we'll do in just a second. Here's the SPX. Again, you can see what's at stake, those key levels, the unfilled gaps now. In the live stream, I thought that we'd rally the morning to 4070 to fill the gap. Check out where it went to. 40.63, very sneaky. I wonder if anyone did get that rally, but yeah, it rallied really nicely in the morning, then it sold off. So we now have an unfilled gap sitting at 40.70. Here's the current market conditions. Now notice I've got a little alert set above that 40.63, and I like that we're back to this level. Now let me explain this. There's a few things I like about it. First up, it's one of our green boxes. Of course, the first box, we went straight through it, no reaction. Then we entered into the box in the previous session and we saw a little rally. That was on ES, the futures that we were looking at over the last 24 hours. So we got that little rally up to the close. I kind of then expected potentially a fade, but we've now found a really critical point. And what happens here is going to be super important over the next 24 hours. Let's have a look at the first reason why. First up, let's get out the volume profile. So you'll notice the point of control sits of the last move here. This is the most traded zone. So the point of control sits right on where the market came back to. This also is the previous demand. So when we scroll down into something like a 5-minute chart, you'll notice a few things occurred. So first up, the markets had a pretty nice little rally here. This was the pickup. into the open. Obviously, you probably would have expected 40.70, but you should have come out of this with either with a profit or a break even. There's no real excuse to lose on a trade like that. But then we see the market now coming down and structuring up. I'd love to see the market kind of go low, breach this in the next 24 hours, then go bullish. And at this period, if you saw something like that, you would know what's going to happen. You would basically say, okay, at this period, pullback should be met by bull demand. And the reason why is because it would structure in the correct way. We know that this is where orders have gone in the system. Where will the orders end up reacting? Of course, you're never 100% sure, but we know also the market has generally been bullish. The FOMC is still a little bit away. We obviously could see a little bit of buyers come back in. But yeah, I'm certainly paying attention to buyers recommencing through this level. It's still in the demand and it's a critical point. Now, if the markets end up breaking through and getting past 40.70, that'll be in a low, a high, and then a lower low and a higher high. At that point, watch out for continuous squeezes. The market is starting to look weak. Obviously, the Federal Reserve will put in place a lot to do with what's going to go on this week, along with the non-farm payrolls. But we're back at daily close levels, demand levels, and of course, the point of control of the last rally. So we're certainly at that zone where buyers could recommence just because the trend has generally been up. If you're a bear in the markets and you've got the longer term approach, you're not really worried too much about these intraday kind of moves. But at this stage, yeah, it's a small minor critical zone, I guess, in markets. Let's have a look at the options moving into this week. And specifically, we'll start off here with stock price to the max pain. So max pain at 398, 410 still have the most amount of calls. We're over 1 million units now on the options market, and 400s are starting to become pretty big puts, 395s and 390s. So we'll be watching heavily what happens with these puts throughout the week and calls. But for now, the market seems to be trapped between that options low expected range, funnily enough, hits around that 396, 397, and then the 410. Have a look again at the SPY. You'll notice that the expectations actually trap between these two zones. So we could be looking at all sorts of crazy volatility this week. You've got to be careful. Remember to protect yourself in markets. In regards to Bitcoin, a lot of people have been messaging me freaking out about Bitcoin. It hasn't broken yet to the downside, so we'll find out. We're at a critical point, previous supply. We know the market sold off, or resistance if you want to call it that. I've got an alert just in case above these wicks just to see how it reacts to that zone. But at this stage, if you're feeling bearish on Bitcoin, you really need to see the market take these wicks out. There's a 1, 2, 3, and I'd want to see that taken, and then the market to potentially move down to the next level. Takes 20,260, and then you could really be talking about some serious declines in Bitcoin. Key levels to watch over the next coming days. As we move through this week, we know there's a whole bunch of news coming out. Let's just have a look here. We've got the CB Consumer Confidence Report at 10 a.m. on Tuesday. Then we scroll through and we get the big ones. The ISM Manufacturing PMI, the FOMC statement, the federal funds rate, 25 basis point hike. Pretty much, I think it's a guarantee. And then we move through to Bank of England, ECB, and then non-farm payrolls and ISM. This on top of earnings makes it a wild week. And I wonder why they've stacked it all together. I'm sure there's a lot of fun and possibly heartbreak to come with these big moves. Expected volatility is set to spike across everything. Be careful out there. Make sure to subscribe if you're interested in the daily shows, and we'll see you in the next one. Also, check out the sponsor of today's video, description down below, as it's your last day. If you fund with as little as 1 cent and set up your account now, very, very soon, you could go into the prize draw to win one of our 5 prizes. Again, more details, link in the description down below. And if you're not from one of the countries, you can always contact the Singapore office, and they, I believe, can set up some people from other countries as well. So check them out. And thanks so much for watching.